Yeah, so good morning. Let's start with fundamental module. So let me give you a brief as to what we will do in fundamental module. So this is our day one, and we're trying to basically do fundamental analysis. Yeah, so the entire agenda of fundamental analysis is the first point is to understand how to pick stocks. Right, so we basically want correct stocks in our portfolio. So that's number one point that we need to address to. The second, when we select stocks, we need to see certain criteria and certain features for that stock. So once you have understood which stocks you want to select, the second part comes is the valuation. Right, so now we need to do the valuation of the same stock. So try to understand, buying a stock at any price does not work. Okay, so we need to be very sure valuation wise also that criteria is being met for us or not. Right, so example, if I like Infosys too much, that does not mean I can buy it in price. Right, so that's very, very important when you're trying to understand valuation. So valuation tells us, is it the right time to buy or not? Right, so timing the market, what people say, is also to be understood by valuation. So the point here is you get the stock, and the second step is you do the valuation. Once you do the valuation, you would know, is it the correct time to buy or not. The third part after doing both, so let's say I select the stocks, which are the good stocks, and then I do the valuation and I find, yes, it basically is a fair valued stock and I want to buy. Third point which you need to understand to how to construct the portfolio. Right, so what happens over here, if you are putting stocks in your portfolio, you need to be very sure, are they worth or not? And second, each stock contribution, or you can say the weightage in your portfolio is very, very important. Right, so you cannot just have a portfolio of 1 lakh rupees invested in one stock. Right, so that's not a portfolio. So the agenda is, how do you define a portfolio? So does that mean I should have 50 stocks in my portfolio, 30 stocks, 3 stocks, 10 stocks? So number of stocks, and more than that, each stock is forming how much weightage in my portfolio is also equally important. So this is the third point where if you understand 1 and 2, okay, the third is the most critical point. Right? Even if I give you the best stock and you get the stock at the decent valuation, the most important point is portfolio construction. Right, so construction of portfolio means defining how much weightage needs to be given to each of these stocks. So this is how we will proceed. The first pointer is to understand how to pick up good stocks. Second would be to do the valuation, and third will be to construct the portfolio. Now the first part has a lot of criteria, but we need to refine our process so that we focus only on few, and then we are very clear which kind of stocks we are looking out for. The second method is way difficult. It's not that easy, but many people apply something called as DCF, right, discounting cash flow, to understand whether the valuation is cheap or expensive. But always understand, DCF is not the only answer, right? So it's basically all the analysts use DCF, but yet they get the valuation wrong. Okay, so we'll understand that, but this is just from our purpose to understand what is valuation. The second point after the valuation, so let's say you do this DCF method and find the valuation, you need to also understand more than the valuation. That means if you're doing valuation and you're trying to buy the stock, you need to be very clear whether it is high valuation or whether it is low valuation. And generally we prefer either fair or low valuation, right? So that's very important. So knowing the valuation, you can buy the stock, and as I said, which stocks to put in your portfolio, how much weightage is required, that's how the progress will take place. So we are going to frame the entire fundamental session in this way, and then you will have some case studies. In the case studies, what we try to do, let's say, take case studies of different industries and which are basically potential revenue getters or potential wealth creators. So case studies will define what? First is the business model. which basically is one of the criteria of the stock. So what is the business model and what is the competition doing or where they stand, and all those things will come out here. After doing the business model, we need to now understand DCF or the valuation part. And once you do the valuation part, you need to basically merge both, that you're trying to buy a good business at fair valuation. Right? So this is how we'll take some case studies, 4 or 5 case studies where we'll understand this asset. So we have revision lectures also where we try to focus on different industry and different case studies. So this will help you to apply these 3 things in this fashion. Right? So first we try to learn this and then we try to apply it on the case studies. Now these case studies are not the old case studies. Okay, we try to take stocks which we want to invest in for next 10 years or next 5 years. What kind of business model we are looking at, how to do the DCF, and how to get the business at the fair valuation. So this will be for potential revenue getters or for potential multi-baggers which we are trying to put in our portfolio, right? So that's how you can relate A, B, C when you try to do this case studies, right? So this is how we have framed the fundamental module. Now let's start with the first criteria, stock selection. Okay, so stock selection is very easy. Everybody keeps signaling which stocks to buy. So if you ask your friends, if you ask your cousin, if you ask anyone, they will have some or the other stocks to tell you. You know what, I think this stock is very good, you should go and buy. The moment you ask him a couple of questions, he will not come back to you again. Example, if someone is suggesting you go and buy any stock, so let's say whichever stock you feel is good. I am saying, let's say Finolex. Okay, so if someone suggests you Finolex, the question which you need to ask is, who is the management? Okay, then you can ask, how much is the quarter-on-quarter growth? Then you can ask, is the profit growing or not? Then you can ask, debt to equity is how much? So there are so many pointers which you can ask that person who is trying to suggest you Finolex. Now when you ask even the first question, who is the management, they do not know. Correct? So this is where the potential of getting the fundamental right goes wrong. Many people think just getting the stock is the right answer. Absolutely not. Right? So the most important part of this is to understand what is required in a stock to make it as a multi-bagger. So first of all, do not try to focus on people what they say. Okay, so do not go to people to get your stocks. That's the first thing. So now we need to understand in our analysis how to get stocks. Correct. So we also want stocks. So we'll also select stocks. Now how to get stock is another criteria. Before we go into getting stocks, okay, let's first understand how does the market move. Right, because ultimately you're trying to select stocks in the market. So you need to have a bigger picture first, and then you can go down and select a stock. So first, let's understand how does the market move. If you go back in history, every year, so let's say at the start of the year, you invest, and at the end of the year, you exit. Okay, so every year, so let's say from 2000, you start doing this. And you keep doing this till 2018. So what we have seen over here, that's basically called as yearly return, we can say. So if you just do a simple analysis over here, what we find here is 2000, there was a huge downfall. Okay, then 2001, no return, 2002, no return, 2003, no return, and then 2004, 5, 6, and 7. Good returns. Then again 2008, huge downside. Okay, then what happens? 9, 10, no return. 11, 12, no return. Then 2013, 14, when Modi ji comes, again the returns started, and then again flat, and so on. So what's happening over here? So when I just go out and see the yearly return profile, can I say every year I get return? What do you think? Can I say every year I get return? No. So this is not an FD, right? That you invest and every year you keep asking for return. So the first thing which you need to understand about equity market They do not give you return every year. Correct? So now we need to understand when do they give return. So markets normally move in three phases. Okay, the first phase of the market is called as earning phase. The second phase of the market is called as price expansion. And the third one is called as market expansion. Okay, or even earning phase, you can also call this as earning expansion. Right, so normally when you see the market, so now we are talking about how the markets are moving, right? So we do not talk about how technically markets are, but I'm trying to see the market from fundamental point of view. So there are always three phases. So the first phase, it's not required that this will come first, then this will come, then this will come. First this can also come, then this can also come, then this can also come. But this will always come last. So among these two, anyone can come first. Okay, but the more or less the last part is the most dangerous part. Okay, we'll understand why and how. So the first point is earning expansion. That means all the companies are giving good earnings. Right, so you're earning 1, earning 2, earning 3, earning 4. Every quarter or every 6 months or so, the earnings are increasing. So that is called earning expansion. So if Nifty earnings, all the stocks in the Nifty, if their earnings are going up, then we call this as earning expansion. Now, if earnings will go up, okay, it is very clear price will also start going up. So you have price at P1, P2, P3 and P4. Now, they have a direct relationship. If earnings go up, price will always go up, because earnings, they act like fuel to the car, right? If there is no fuel in the car, car will not move. Okay, and even if it moves, so let's say earning is not there and price moves fast, what will happen? They will come down also very fast. So if you want your return to be sustainable, or the return should keep coming, what should happen? Earnings should keep coming. Now, the problem here is, if you ask anybody who will tell you buy this stock or that stock, they do not know what's happening on earnings. 95% of the people, they know where the price is headed, right? If you ask them yesterday's closing price, they will know. But if you ask them previous quarter earnings result, they do not know. So try to understand, people are more focused on price than value. They do not understand where the earning is going. If earnings do not come, please understand, price cannot go up. Okay, so how does price will go up? Rather than seeing the price, we should start tracking what? Earnings, right? So whichever stocks we will select, what we need to do? We need to keep tracking the earnings. If earnings do not come, price will not move up. If earnings come, price will move up, right? So that's the clear relationship of A and B. And that is why earning expansion means earning is increasing. Okay, and back of earnings, so if earnings are increasing, what will happen to price? Price will also start moving up. And because if this happens, what will happen? Price expansion will happen. Now try to understand. If a company has given good result for 1, 2, 3 and 4, what is the expectation set for next 4 quarters? It will still give good results, correct? So then suddenly all the people start buying this stock because it has given consistent earning returns or not. So earning is growing consistently. Everybody starts buying this stock. So what will happen to price? They will move more up, because suddenly the demand for that stock increases, correct? Everybody wants to now buy those stocks where the earning potential is going higher. So what happens over here? Price was moving same as earnings. Earning increased, price also increased. But then what happened? Earning increased this much, but price increased more. Again, earning increased the same rate, but price increased more. So what are we witnessing? Price expansion. So can I say price is moving way ahead of earnings. Correct? So what is happening? Earnings are going up in a steady rate, but apart from this, price was going at steady, now it became unsteady. Means price have started moving very, very fast. The third phase kicks in, and the third phase is called as market expansion. Now, what do you mean by market expansion? If for a company this is happening, then this is happening, and then if market expansion happens, market expansion means the entire Nifty is going up. So example, in 2013-14, what happened? Modi ji came and then the Nifty started going up. So all the stocks, they start going up. So that is called market expansion. So if you have earning expansion and then price has already expanded, and then on top of that, what happens? Market expansions. Don't you think the price will zoom like rocket? Correct? So earnings will come this much only, but the price will just blow off the roof. So what will happen over here? If your stock or portfolio is in this phase, you have to be very, very cautious. These are the phase which is called 2000, which is called 2008, where the crash comes from. Correct? So the point here is, where I'm trying to make is, we have to be very, very cautious about the last phase. See, the first and second phase will keep happening, but the last phase is very, very critical. Okay. Now, what happens with us or the retail people? 95% of the people, what they do, when earnings are going up and price is not moving, nobody is interested. That time, who is interested? Only the big guys who want to invest for long term, right? Then suddenly what happens? The earning goes up and the price shoots faster. And if the price shoots faster, okay, what will happen over here? Now suddenly everybody is interested. Still, the retail participation will be 20% to 30%. Suddenly what will happen? Market expansion and all the people are interested. So try to understand. When markets move at this stage, no one is interested. When market starts moving up, so this I am talking about price. Price doesn't move much, then the price moves faster, and then the price moves way, way fast. If the price moves in this phase, which is way, way fast, called market expansion, the major retail janta comes where? In the third phase. So they do not come in the first phase, they do not come in the second phase, they come in the third phase. So they are always late to the party. Now, if they are trying to enter over here, okay, which is called market expansion, what will happen? Correct? So they invest over there and then they keep crying, right? I invested and the portfolio has gone down by 30%, 50%. Yes, it will go down because your entry was right or wrong. Now, the best part is, many people say, if you buy blue chip, you will never suffer. Okay, let's talk. 2000 was called as which crash? .com, which is IT crash. 2008 was called as real estate, oil and gas crash. Okay, so you had two big correction. And if you go back, if you want, 1992, it was cement, which basically went down. So let's talk about this. Let's say in 2000, this is 2000 here, and I'm trying to invest at the top of the market. Okay, and I am investing in the best blue chip called as Infosys. Right? No one will argue Infosys, top company, IT is a giant of India and everything is fine. But I'm buying it when? During which phase? The market expansion phase. And I'm buying the best company and I'm saying that it's a blue chip. You do not have to worry. Just invest and forget. Okay, fine. I invested and I forgot. Then what happens? Whatever was this price, it came down 80%. Number one. Okay, so you had a good heart attack. In 2000, straight away 80% goes away in the best blue chip stock. And then it took 6 years to come back. So the good part was blue chip at least gives you money back. Otherwise your money would have vanished. So the point here is, even if you buy the best stock, but at the wrong time, will you get return from market? Absolutely no. You understand? That's what people do not understand. Okay, so what they try to do, they are only seeing price. They do not focus on earning. That's number one. And number two, they even focus on price. I'm not saying wrong, don't focus on price, but even if you focus on price, but you enter where? In the third phase. So you're very late to the party, and then finally when it kicks in over here, you invest all your money over here and you have to suffer the loss. So what is happening over here, what we need to understand, can I simply say the stocks or the sectors which have already performed, we should not invest. Like example, if I now invest in Infosys, okay, or TCS, will I get huge returns? No. You will get 10-12% return, you should be happy with it. Correct? So the point to be understood now over here is, we need to go back and see which sectors have performed. And the sectors which have performed, never invest. Okay? So the past performance, now tell me, in 2000, everybody wanted to invest only where? Then a huge crash came. Again, if you ask them where you want to invest, they'll say IT. Correct? So the point is, if he is the hero of a bull run, IT, please avoid IT. So always tend to forget the hero. Try to find the new hero. So what we are looking out for. So when you are trying to select stocks, we need to first understand what? Sector. Right? So the point here is to be understood. Forget about stocks first. You need to understand the sector. Which sector will perform in next 10 years? That's the question should be asked. And the question should be answered, why will it perform? Okay, it should be logically very clear. The first thing, if you tell me IT will perform in 10 years, absolutely wrong. Why? Because IT has already performed in 2000. Okay, then you go out and say, okay, fine, I think oil and gas will perform for next 10 years. Again, wrong. Why? They have already performed. So what we are trying to look over here, the sectors which have not performed. Right? So before even going to stocks, you need to understand two important elements. First, how does the market move? And second, how does the sector move? Okay, and if you can understand these two logic, selection of stock is very easy. Because to select a stock, we have a process, and if you go through the process, you do not have to worry at all. So the point first to be understood is how to see the market, and second, which sectors to look into. Okay, so the first question was how to see the market, and how did we saw the market? Market has three phases. One is the expansion phase, then the price phase, and then the market expansion phase. Now in this earning expansion and price expansion, it is still fine, right? So you are basically over here. If you're trying to invest in this range, you will still make money. But if you go into market expansion and you invest over here, you will never make money. Okay, so that's very, very clear when you make money and when you do not make money. So the point is, don't you think, if I find sector which is in first phase and invest, what will happen? If I tell you a sector which is in first phase and I invest in that sector, good or bad? Because after that, what will happen? Price expansion. After that, what will happen? Entire market wants to buy. Okay, and I'll be sitting over here investing in that stock. So that's where a huge return will basically come into your play. So only thing that we need to now understand, A and B, and where we should not enter is B, and where we should enter is A. Correct? So the answer should be, I want to invest in A and I want to exit at B. Right? So the first question, it's very easy to say, okay, I'll invest in A and I'll exit at B. But the only thing is, it's very clear, will I ever go and buy something in B? No. Correct? So if you avoid your mistakes, okay, still you are making money. Please understand. Because even if you would have invested in Infosys 1 lakh rupees, 80% gone. Correct? So at least if I would have avoided Infosys that time, don't you think I'm getting the same Infosys 80% now? Why are you looking at investing in Infosys here? If you would have invested here, what would have happened? 5 times the return, which is coming from the lower base. So the point here is to understand which phase the market is in. Okay, and when market turns in the third phase, means everybody is bullish. You need to be cautious. So example, Modi ji comes back. Okay, you have the election May 2019. Modi ji comes back. What will happen to Nifty? Right. So first we need to understand currently where the market is. Is the market in first phase? Is it in second phase? Is it in third phase? Okay. If I tell you market is in second phase and Modi ji comes, good news or bad news? Good news. Where will it enter? That's it. So the point is, if it enters into market expansion, now try to understand. Nifty is already at 12,000 range. Okay. And market will zoom once Modi ji comes back. Okay. Then what will happen? Straight away it will go to 14,000, 15,000 or no? If it goes to 14,000, 15,000, in matter of 1 year, what will you feel? Oh my God, I have not invested. Okay, I lost the opportunity. I was just seeing the market to correct and it never corrected. And what will happen? I'll invest at 15,000. And when I invest, it will come back to 10,000. Please understand. Why? Because you invested in which phase? Market expansion. Please understand. So the first point is to understand, to know for sure where we are standing at present. And that's what Howard Marks says. Okay, and he's the best investor. What he tries to say, forget about what will happen in future. That nobody knows. But at least I should know where am I standing today, right? Where is the present scenario? Where am I standing? Am I standing at A, B, or C? If I'm very sure where am I standing, if I tell you I'm standing in C, what will I look at? Adding more funds to the portfolio or exiting some of the portfolio? It's very clear. And suddenly when I know I'm standing in 1, what will I do? I'll put whatever funds I have into the market, plus I'll borrow more, I'll break my FDs, I'll borrow or I'll get leverage, and then I'll put more money into the market. So the point here is first to understand where you are standing. People do not know where they stand. They all want to know which stock to buy. Try to understand. If you ask anybody, you want to do investment, very good. Can you tell me 10 good stocks to invest in, 3 good stocks to invest in? So they only want what? Stocks. They don't want where the market is standing, should I enter or not, how much I should put or not, all that stuff we don't know. Okay, so even if I give him the best 3 stocks, he will still not make money. Why? Because he'll invest in Infosys, the best stock, where? At the top of the market. So this is what one has to understand, where are we standing. Okay, so this 3 phase which we are trying to see, okay, the earning phase, the price phase, and the market phase, we are seeing this for the market. The same phase can be seen for the sector. Okay, so the same idea, the same logic can be applied for the sector, right? So if I tell you that banking, currently all the banking or financials are almost in between price expansion and market expansion phase. So they are at the critical juncture. If Modi ji comes and the rally happens, they will enter into which phase? Market expansion. Everybody wants to buy Yes Bank or Kotak Bank or IndusInd Bank and everything. And when they will zoom one way up, what they want to do? They want to buy more. And then what will happen? A steep downside will come into place. So the point is to understand first where the market is. So you have got a general sense, what is the mood of the market? Is it in this phase, or this phase? The second point which one has to understand, how are the sectors performing? If you take all the 10 or 15 sectors, you need to go and see whether they are in phase 1, they are in phase 2, they are in phase 3. If a sector is in 2 and 3 phase, am I interested? No. Is it clear or no? But if I get a sector which is in phase 1, am I interested? Absolutely. So this is how you need to first understand where the market is standing, where the sector is standing, and then go out and invest. Okay. So now if you have understood a little bit of what I'm trying to make out, I'm trying to make out where the markets are, right? That's the only point which I'm trying to find. Second, along with where the markets are, I'm trying to also find where the sectors are. The same logic which I'm trying to apply for market, I'm trying to apply for sector. Okay. So the first point, if I tell you that I have got sector 1, sector 2, let's say banking and financials or NBFCs, or these sectors are basically in phase 2. And if I tell you there is a sector 3, sector 4, which are more or less in phase 1. And I tell you there are some sectors like sector 5, sector 6, which is in phase 3. And I give you 1 lakh rupees, where will you invest? So if I give you 1 lakh rupees, where will you invest? You have 3 options, either in 3, 4, either you have to put money here, put money here, put money here, or you want to distribute or whatever. So what would you recommend? Where would you invest?
70% in S1.
So you are saying 70% in S1, S2, okay, and 30% in S3, S4, okay.
15 S3, S4, 13 S1, S2.
You are putting 15 here,
Yeah.
okay.
Very short S5, S6.
Short, you cannot go short. This is not trading. You have to invest. So I'll also make you understand how to protect your portfolio. But you're saying 15% here, 50% here, and rest 50% where is? 50% here. Okay. Anyone else?
50, 70, 2 and 1.
30 and this one is
in S1, S2, maybe 10%.
10%. Okay.
And S3, S4, the rest
90%. Okay. Anyone else? So I got 3 and 4. 3 and 4. This one you're saying. Okay. So what I'm trying to say, these are some sector names, but I'm trying to give you phase of those sectors. Okay. So the phase of this sector, there are few sectors whose phase is 3. That means they are already in which mode? Huge uptake every quarter or every 3 months. They are making fresh 52-week high. Okay. If you are investing in this sector, and this is what majority of people do, they invest over here first. They'll put 90%, 80% of their capital over here. Why they will put over here? Please understand. Because all the fund analysts will recommend this. Okay, any TV channel you will see, they'll recommend this. So what will happen over here? Majority of people get concentrated in the third phase of those sectors, so which we are not interested in. Now the answer is correct. If you are in the first phase, if you are in the second phase, this is where we are interested in. Okay, so we do not want to capture in what? The exuberance level, the madness which is there. Let's try to avoid that. Okay, and why we are trying to avoid that is in this you might miss a big upside. I agree that these sectors might give you 30% when Modi ji comes. So you said do not invest here, you invested here, and these sectors did not move. Let's say this sector gave appreciation of 30%, and this one was in first phase, it gave appreciation of 5%, and this guy gave appreciation of 15%. So your friend will laugh at you. You were saying don't invest, just see what happened. I have made 30% return, you have just made 5% and 15%. So when he will laugh at you, what he will do over here, rather than booking his 30%, he will put more money. Because now he is overconfident. I got 30% this year, I'll get 30% next year. And what should I do? I should not put 1 lakh rupees, now I should put 2 lakh rupees. So what has he done? If he has put 1 lakh over here, he puts 2 lakh over here. So is he putting more money or less money? More money. And is he putting at the higher level or lower level? Higher level. So there are two biggest culprits who basically kills your return. Number one is what you have done is called scaling. And you have done scaling at the wrong points or right points? Wrong points. Correct? In the exuberance level, you are putting more money thinking that I'll make faster the returns, and that does not happen. Correct? So the most important point to understand is how to do scaling, that we'll understand. But more than that is selecting the right sector at the right time. Every sector is not right at the right time. Please understand. Right? So that's very, very important, and this is the biggest lesson that one has to understand. And now please understand, if you would have invested over here 90%, you did not get any appreciation. Okay, and then you start questioning yourself. Okay, I have not even made FD return. I should have also invested over here. Okay, it's very tough to not make return. Please understand. Okay, and knowing that these sectors will perform, okay, and will give huge return for a year or so. So what's happening over here? Okay, when you are trying to look for this 5%, do not look at 5%. Now try to see. This guy puts over here, he's very happy for the next year or so. Suddenly it falls by 50%. 50 I'm saying is minimum. The sector who is in the exuberance level will go down at least 70% to 80%. So the fall will be very, very brutal. And the best part, what he did was 1 lakh here and 2 lakh here. So his average price is nearly at the top or not. So he lost 70% of his capital. Okay. But what we have done, when this goes down 70%, my portfolio or these sectors which have already not performed, okay, will not go down more than 15%. Because the sectors are already down, corrected. Okay, they will not go further down. Please understand. Even if they go, they will bounce like a ball. It will go down and it will jump up once again. So the point is, relatively 15% your loss and relatively 70% is loss. Now where you want to stand, right? So this is where you will understand. People will laugh at you and they'll say, I've got fast returns. All the best. Because we don't want to get fast returns. Please understand. Those who want to get fast return, you cannot invest. Okay, and then I don't know, there was a dialogue which was shared between Jeff Bezos, the Amazon guy, and Warren Buffett. The Amazon guy is asking Warren Buffett that your process of selecting stock is so simple. Okay, why not everybody follows your method and become rich? Okay, and this is what he answers. So Warren Buffett says, nobody wants to become rich slowly. Please understand. Everybody wants to become rich fast, right? So if you want to become rich slowly, okay, you need to select these kind of sectors. Do not go into exuberance. It's fine if you have missed an opportunity. We'll find another opportunity, right? And this is what major learning is there. It's not about getting the right stock. It is not about putting a lot of money on the right stock. But most importantly, if you invest in the best stock at the wrong time, are you getting killed or no? So all we need to do is understand the market phenomenon, where it is standing, understand the same for the sectors. So individual sectors, if you go out and see, and once you have understood the sectors, then you should go out and invest in the stocks of that sector. So this is how the process of investing should be followed. Okay, and it's very difficult to go out and invest in the sectors which are not performing and the sectors which are performing. 90% of people want to invest where? Sectors which are performing. Okay, they do not want to perform or get into those sectors or those stocks which are not moving. Because, as I said, they are more fixated with what? If they invest and for 6 months, if the price does not move, what will they do? I don't know which stock I have taken, it is not moving. Are you getting me? And the day when they sell, it starts moving. Right? For 6 months, it did not move. I kept holding on to the stock. It was ranging in 300, 280, 300, 280. And suddenly when I sold at 320, it went to 600. Because he was waiting for you to exit. So the point to be understood is, you are fixated with what? Price. Right? And that's where 90% of the people are only fixated with price. If you ask them what is the price of ABC stock, they will tell you point blankly. They will also tell you in depth till paisa also what was the closing of yesterday. Correct? But if you ask them last quarter earning kitna aaya, that I don't know. Correct? So that's what I'm trying to say. We need to focus on not on price, where? On earnings. What the industry is doing, what the stock is doing. And then you should have a clear idea where it will go. Because if earnings will go up, what will happen to price? So please understand, price will always follow earnings. If earnings dry out, price will also go down. If earnings kicks in, price will also go up. Right? So this is what one has to understand. So what have we understood till now? Two important principles. One about market and one about sector. In market, we understood three phases of the market. Right? So market, we had three phases. and we are more interested in the earning phase, and we try to avoid the earning, or you can say the price phase, and we try to avoid what? The next part or the last part, which is the market phase. Right, so that's number one. Coming out to number two, once you understand where the market is standing, we go out in step two, and in step two, we look at sectors. Okay, now in this is where you will find your diamonds. How to identify it is in phase 2 or phase 3 and all those stuff. Do not worry, I'll explain you each of this stuff. So first try to get the bigger picture, and then we get into details how to understand where things are. Coming out of sectors. Now in sectors, again you have two types of sectors. Sectors which are performing very well, that means they are in phase 3. And sectors which are in phase 1. Let's talk about extremes. Phase 1 means not performing at all, not moving at all. And then you have certain sectors which are moving. Okay. So again, when I see sectors, you have two kind of sectors. One is hero and other is zero. Okay. Everybody are interested to invest where? In the hero. But we are interested to invest where? In zero. Right? Why are we doing that? We are doing this because if a sector has not performed for a long amount of time, let's say 10 years, if a sector does not perform, okay, and that's the best sector to bet at. If you want to bet at the best sector, you need to go back and see in the past 10 years what has happened in that sector. Okay, if the sector, or let's say what has happened to the top companies in those sectors, have their profits gone up, have their sales gone up. So there are certain times where last 10 years have been very bad for a company. Bad in the sense sales are going up, earnings are not going up, profits are not coming through. Okay, so something is happening in that sector. So the point is, in phase 1, if the sectors have not performed for 10 years, I'm trying to look at those sectors. Correct? So basically, when I'm looking at sectors, I'm very clear, I'm looking at sectors which have performed or which have underperformed. We are looking for sectors which have underperformed. And not for 1 year or 2 years. We need this underperformance for 5 years or 10 years. So if a sector has not moved for 5 years and 10 years, this is where we are interested in. Yeah.
By underperformance, do you mean the movement in the price of the stock?
Not the stock, of the sector.
Of the sector?
Correct. The movement is basically we are looking at the price. So we'll come in each of these pointers, so do not worry. So first I'm trying to say, the sectors which have not performed, people will not be interested. Please understand. If sectors do not perform, okay, for 3 years, 5 years, 10 years, people are not interested in those sectors. And if people are not interested on those sectors in the underperform, they are more interested where? The one which is performing. Okay, so the point is to be understood. We need to focus under the underperformed sectors. Okay, so the first point is very clear about the market. Second point is very clear about the sector. Now, if you have found, let's say, 3-4 sectors which are not performing or going sideways, or maybe which is not in exuberant level, more or less the earnings are going up. So it's basically phase 1 or phase 2. Okay, those sectors will become your portfolio. That means the third stage of selecting the stocks have to come from which sectors? Underperform sectors. Okay, and if you can get this right, okay, you can never have a bigger downfall in your portfolio. Please understand, because of two things. If I tell you there is a sector called as infra, there is a sector called as real estate, both the sectors have not performed for last 10 years. I'll give you one more sector, hospitality. The hotel sector, you can say, has not performed for hotel sector has not performed for last 20 years. Okay, these have not performed for last 10 to 12 years. Now question first is, are these sectors underperformed? And not for 1 year or 2 years, but for 10 years. The second question now comes, okay, they have underperformed, I will find stocks under these sectors and I'll invest. Okay. So let's say in infra or industrial stocks which are there, I'm investing in L&T. Since you know the names, I'm just trying to take that. Real estate, I'm trying to invest in the best stocks. So not the DLF or Unitech, which has a lot of debt, but the stocks like Godrej Properties or Oberoi, which are there, and all those things. So the stocks we will go later, so don't worry. Hospitality, if you want to invest in the hotel chains which are there, so we have Taj and we have Oberoi, so it's basically EIH, East India Hotel Company, which is there. So I'm just trying to take some names, so we'll come into stocks later. But what I'm trying to now say, let's say I make a portfolio of these stocks and I add something called as new themes. Now we'll understand what is this new themes. So the entire economy, when they change or they go from one phase to another, you will have new themes coming into the market. Okay. Now everybody talks about automation, AI or not. Nobody talks about IT anymore. Okay, because this is the new thing. Everybody talks about IoT. Everybody is talking about automation. Everybody is talking about industrial revolution and those kind of stuff. The second part, many people are now talking about more amount of medication or diagnostic, right? So if you remember last 10 years or last 20 years, when we used to go to doctor, okay, he used to first give his medicine and then he used to say, come after 2 days. Now you go to doctor, first thing he will say, please do these 4 checks. So get the blood test done and then we will talk. Okay, we do not know whether you have malaria, typhoid or what. So the point here is these are called as new themes, which was never there before. Now they have come. There was never life insurance before, which was given so much of significance. Now everybody has started giving life insurance or medical insurance as a new theme. So you will have some new themes which will come from now. If we can find new themes, it's very good because it has never gone up too much, and then we are trying to invest in new themes, or we invest in the old themes which have not performed for 5 years or 10 years. So you have a mixture of two things. You are trying to invest in the new economy, the new themes, and you're trying to invest in the old economy, the old themes, right? So there is a theme mixture that we'll try to put in our portfolio called as new themes and old themes. Okay. Now coming first to the old themes, and we'll have new themes later. Now coming to the old themes, let's say infra and real estate has undergone a huge underperformance for last 10 years. Fine. So I went out and I bought a index fund of infra and index fund of real estate. So if I do not know about stocks, I can just go and buy a mutual fund, which is basically focused on real estate fund or focused on infra fund. If I invest in these two funds, okay, and Modi ji does not come, correct? So I invested 5 lakh rupees each, 10 lakh is my portfolio. I invested in 2 mutual funds, and Modi ji does not come. What will happen to the market? Market will go down 10, 15, 20%. But if market collapses, please understand, I'm not saying these sectors will also not go down. They will also go down, but the potential of downside is very less. So the point is, if the broader market goes down by 50%, if your investment is in this, which is already underperformed, will not go down much. It will go down maximum in like 20% or so. Now the best part over here, fine if the correction has come. If the correction has come, in the downside, am I losing much? No. So that's understood. Because my peers are losing 50%, I am losing 20%. See, if market falls, you have to give away that some gains will go out, okay, or you might not make returns. Now coming to the second point. Now when the market starts going up again, the question should be asked, which sectors will move? The sectors which have underperformed will start moving up. So when the market starts moving after a crash, which sectors moves first? Those sectors will move first which have underperformed. So don't you think you will be at the bottom where you will see phase 1 coming, then 2 coming, then 3 coming, in which sector? In the underperformed sector, right? So this is what we are trying to target. We are trying to look for underperformed sector, try to invest so that downside is not much because it's already corrected too much. It will not correct more. And second, when the uptick comes or whenever the bull run starts again, or when the uptick comes, you will basically see these sectors will revive faster. right? So the question to be understood here is things which nobody talks about, you should go and invest. Okay. If everybody wants to buy HDFC Bank or IndusInd Bank or Kotak Bank, let them invest. You should not be there. And it's very good. If you ask 50 people and if everybody is saying Kotak Bank and IndusInd Bank, okay, what should you do? Do not invest. Right? And you should tell them, when you will tell them I'm investing in Siemens or L&T or AIA Engineering or all these heavy engineering kind of companies, they will say you're mad. They have not given return for last 10 years, what they will give, right? That's the exact thing that you want, that they have not given returns for last 10 years. So this is what happens. If I would have invested in L&T in 2009, 10 or 8, in 2008, L&T was at lifetime high, the maximum return because of the infra boom. Okay, and then if you see after 2008 to 10 years, he has not given much return, not even FD kind of return. Right, a blue chip stock not giving you return, that means your entry point was wrong or right? It was wrong. So if somebody bought in 2008 or 7, why will they buy? Because everybody enters in the which phase? Third phase. If he has bought 1 lakh rupees, 2 lakh rupees of L&T, every year he's seeing L&T is not giving me return. And when you tell me now you should buy L&T, what will he say? For last 10 years, this guy has not given return. What will he give return in next 10 years? That's the exact answer we want. Last 10 years, he has not given returns. Very good, right? So that means you have suffered a lot, okay? And I now know I should enter this stock. So the point, what I'm trying to make is, when you suggest people these sectors, the first thing that they will say is negative. Do not invest, okay? And that's why do not discuss or do not try to say you invest in this sector, because you have made some conviction or no. And if you tell 10 people, they will turn your conviction upside down. Because if you made some mind and you have invested, and what they will do, they'll try to put all the negative points, and then you will start thinking, yeah, they are right, let's change the agenda. So what happens over here, this is not what people want to hear. Okay, and that's what you need to understand. Do not talk where you want to invest, but you need to be very sure where you're not investing. Forget about where you want to invest. You should be very clear where you're not investing. So are we investing in sectors which are in this phase? Absolutely no. Right? So this is what you need to understand. So there was a good phenomena which happened in ILFS issue. Okay. Before that ILFS issue, try to understand, every other IPO was NBFC or SME IPOs were coming in. So every other IPO was NBFC. Stocks like Ujjivan or Equitas or Satin Credit, from 200 rupees were going 3 times, 4 times. Like there is no one else. If you do not participate or do not buy the stocks, you are out. Right? When that kind of exuberance is seen, what happens? It just takes a small phenomena, ILFS, and they are all down 60%, 50%, 80% from the lifetime highs. Correct? So that's what one has to understand. When you enter in the exuberant phase, all you're trying to do is catching up on returns. The moment you catch up on returns, then you'll start catching up the price. Because the point is, you'll try to enter at the as fast as the highest price, and then what will happen? A sharp fall and you're out of the game. Right? So that's what I'm trying to say. Do not go here. Try to go for phase 1. The good part of phase 1. First thing, it has not zoomed up. So you have enough time to do your research, enough time to put money even on the SIP format. Right? So you do not have to come in and lump sum. So this is very good because they have not performed. That's very good for us, and we have enough time to invest in. Coming out in the second time, apart from the old, you can now put what? New themes. Right? So you can look at sectors, which sectors have performed or not, but these sectors are the old sectors. These new themes can never become sectors. Please understand. Do you have an insurance sector? No. Why? Because this has not yet become big enough to make it as a sectorial index. Please understand. Right? So that's good for us or not? Till they become a sectorial index, and if I invest in these companies, it's very good. Right? So they are basically classified as new themes. Okay. Same way if I tell you diagnostic companies or hospitality companies, right? So they all come under pharma, but their weightage is very, very less. Right? So again, you need to understand these are the new upcoming themes which are there. So again, the agenda is, now I have a clear idea. My portfolio will have stocks which are coming from two parts. One is the new themes and the other one is the underperformed sectors, right? So the question now is how to find these underperformed sectors, number one, and how to find the new themes, right? So we have understood the market. So now we need to understand market. How do you know which phase the market is in? Okay. Second, you need to go and see sectors which have performed and which have not performed. And third, when I'm making my portfolio of new themes and these sectors, I need to be very clear which sectors have not performed. So where I can understand all this information, okay, all I'm trying to say before getting into stock is to first understand the structure, okay, get your mind clear what you're trying to look at, right? So you're trying to look at market, then you're trying to look at sectors, and then you're trying to look at new themes. And using this underperformed sectors and new themes, I will create my portfolio, correct? Once you know where to look, all you need to know how to look, correct? Once you know, okay, fine, I'll be searching things in what underperformed sector. Okay, fine, I'll be searching in what new themes. Now we need to understand how to look. Okay, so first, how do you know sectors have underperformed or not? Okay, so how do you know which are the new themes? So once you need to know which sectors have underperformed, or you need to know which themes are new themes, what you need to do. So there is a very small exercise which one has to follow. Okay, so have you heard of Economic Times? Right, the brown paper which comes, do not read. Right, so that's very important. So Economic Times, which is brown paper, do not read the paper. Inside this, there is two white paper. Any idea? No, brand equity comes on Thursday or so. Two white paper are basically called as ET market. Right, this is what we need to read. Now in this also what you need to read, please understand. On this paper, okay, every day there is one question and answer of fund manager. Now these fund managers can never tell you about stocks, but they can tell you about sectors and themes, correct? So the first question was, I want sectors and themes or no? So you were asking me, where will I get this sector and theme? So I'm telling you, all you need to do is go to this paper, morning, open this paper, inside this two white paper, and there is a question answer session on the fourth page. So if you see, this is like 2 pages. So 1 page and 2 page. If you open it out, on this side, you have this question answer. Now, in this question answer also, if you want to read all the question answers. But if you want to avoid, just read one question. Because every time in that question answer, they always ask which themes or sectors you like. Right? And we are also interested only in that, because rest of the question is all time pass. Where do you see market going? What will happen to election? What will happen to this and that? And we are also not interested, as Howard Marks said. Right? Where things will happen, I am not interested. What I am trying to understand, which themes or which sectors you are interested in. Okay? Do this exercise for 20 days. Means for a month. It normally comes on Monday to Friday. What you will realize is, every fund manager comes and he says, these are the sectors, these are the themes which I like. Okay, and if you read for 20 days, 18 people out of 20 are saying the same stuff. So 18 fund managers, if you're asking 20 fund managers, out of which 18 fund managers are giving you the same answers. You should invest in private banks, NBFC looks good, auto looks good, and all those kind of stuff. There will be only 2 guys who is out of the box. He says certain things apart from what the other people are saying. Once you find those 2 boys or those 2 fund managers, you should only follow them. Why you are wasting time on 18? Is it clear or not? So now the question is, who are those 2 fund managers? A, you can do the exercise, or now I'll tell you which are the fund managers whom you should listen to. Correct? So the first point is, you are throwing out the noise and you are trying to fixate only on those people who are looking out for what? Stocks or sectors which have underperformed and new themes. Correct. So let's see. So you can now start reading this and understand some new themes or new sectors which they are trying to bet on. So these are the people whom I normally follow. Okay, and they are very, very good. They have much experience, that is fine, but they are good in this format. Please understand. There is one guy called as S. Naren. Have you heard of him? Okay, this is the guy from ICICI AMC. He does come on television also, but this guy is exactly opposite. So everybody is buying A, he will buy B. Okay, so he always goes into those sectors which people are neglecting. So this is what I want or not, correct? So this guy last time said, right, he started being bullish on infrastructure and real estate. And he was asked, why are you being bullish on these sectors? Power, infra, and real estate is what he was trying to answer. He said, why am I interested now? Because the simple answer is it has not performed for 10 years. So what answer he gave, why am I interested in these sectors, is because it has not performed for 10 years. So the best part is, don't you think I wanted those sectors which have not performed for 10 years? Correct? So we are interested to listen to him always because he talks contra. He will not come and say, I'm liking private banks, right? So he'll not say that. He'll try to see where the underperformance is there. He's also liking telecom sector. Okay, the Jio is there, but he's not interested in Jio, he's interested in Bharti Airtel. So the point is to be understood, he is always contra or no. Okay, the stocks or sectors make 52-week low, he's interested in those sectors. Okay, the best part is when he comes and says, I am interested, it looks promising, then you should start focusing. If I tell you I like real estate, okay, or infra, so they have not performed from 2009 till 2018, please understand. If I would have invested in 2015 or 2016, 17, am I wasting years or no? Rather than that, wait for his signal and then start looking into that sector. As simple as that. Because this guy tries to time when the uptick will come in this sector. So the first thing what we need to know is which sectors to focus at, right? And when to focus at. And if you listen to this guy, he does not even give you sector, but he also gives you what? It's the right time to focus on this sector. Please understand. Correct? So don't you think next question you would ask, when to invest? Okay, should I just go and invest right now or wait for another 3 years, 2 years? When will this uptick come? So he is the best guy. He also tells you what, I'm now interested in these, or these sectors look more promising. So that means he's trying to focus on these sectors. So this guy is very, very good because he starts focusing on what? Sectors or stocks which are underperformed, right? So underperformance is very, very important. So that's the first thing. Okay, there is another guy called as Kenneth Angrade. Now he was in IDFC AMCs, but he exited that and he started Old Bridge Capital. So he started his own EMS, and even this guy is very good in understanding two important things. One, he doesn't look for a turnaround. Means after 10 years, which sector will move. He's not looking for that. Why I like this guy is because he talks about new things. Okay, so this guy, he always talks about new themes, what will happen, and this is why we are more interested in this guy, because he talks only about 10 years. He doesn't talk about 1 year or 2 years. Okay, so the agenda is very clear. He's looking for very, very long term or not. That's very good. And then where is he seeing good opportunities in which sectors? So the first point from Kenneth Angrade, so I'll tell you what he used to do when he was in IDFC in 2000 or 2003 or so. This guy was focused on FMCG. So FMCG as a sector. So that time nobody used to talk about FMCG. Why? Because everybody was talking about IT. Okay. So that time this guy said FMCG will become a huge compounder in next 10 to 15 years. And if you see now, all the FMCG companies after this 2003 and 4 or 5, so even if I take from 2005 to 2015 for 10 years, has given more or less compounded return of 20%. It's huge. right? So the first point to understand is, don't you think he has a knack of finding the sector which will perform in the coming 10-15 years, right? So that's number one. Number two, what he said in 2009 and 10. In 2009 and 2010, he said banks will do good. Banks and financials. So you're talking about private banks or you're talking about NBFC. Now everybody is saying they will do good. But he used to say when? In 2010 and so. And again, if you see for 10 years, banks have compounded by 20% or so. So what is this guy trying to look at? He looks at the story for next 10 to 15 years. He basically gives you the sectors or new themes which will erupt in next 10 years or so, or which are the sectors currently but will become big in next 10 years or 15 years. Now the question you would ask, what has he told now? Correct? Because if we can start focusing here, then we can again make money. So this is all about old what you're trying to say. Let us listen to him now and let us see what this guy is saying. This guy is saying you need to focus on rural economy, and he has already explained why. If you see rural economy, 70% of the population stays in rural India rather than urban India. Now if you tell me whether Modi ji comes or anyone comes, will they favor rural or they will not favor rural? They have to favor rural, please understand. So first thing is that. So keeping that election point of view also into account. Now he's saying why this economy or rural part of the world of India will have to go up. Okay, why is he saying that? Is because if India has to grow from GDP point of view, if India is 1 trillion and then 2 trillion, and if it wants to become 4 or 7 trillion economy, don't you think the 70% of population where it lives has to go at the upper level or no? Correct? That's the basic level of agenda which he was trying to say. And the second point what he tried to say was this sector or this segment has not performed for last 20 years. Nothing big revolutionary changes have not happened. Okay, and this is for the first time, at least in 90% or 80% of the rural places, everyone has electricity, which had never happened prior. Right? There is infrastructure or roads getting built into rural places, which had never happened 20 years prior. So, don't you think a small change of providing infrastructure or providing electricity, what will happen? Everyone will start placing shops, everyone will start doing more construction activities. So those things will start happening over there. What will happen to this segment? It will start going up. Correct? And that's why he's saying it is now poised for next 10-15 years for this economy to go up. So what segments or what sectors we can look at is basically modern agriculture, everything. So anything related to now rural India will have a huge scope in next 10-15 years. Right? So if this guy who already said FMCG, who already said banks, and he's now saying rural India, correct? So we should basically listen to this guy and start digging for companies into this rural India, right? So that's very, very important. Reliance is focusing on fiber TV in rural India to promote agriculture and education. Yeah. So Reliance is getting into many things, but the base is Jio and all those stuff. Try to understand. If the same Jio would have come 10 years prior, he wouldn't have been so successful. The revenues are going up 60%, 70% every quarter. How? It's because electricity is over there. Correct? So one, electricity has reached, second, infrastructure has been built. All that will add on to this rural economy. So if you're trying to see this economy will go up, that is the right time. Why it will go up, right? So this is what he was trying to say. So he's trying to say one segment is rural India. Okay, so let's first understand what segments he's trying to look into. Second, what he's trying to look into apart from rural India is media. Media and entertainment. Right? And if you see now, he's actually correct. Everybody is now focused on media and entertainment. Right? So you have Netflix, kind of, Voot is there, Hotstar is there, all these OTT platforms which are there on media segments which are also kicking in. So this is also one of the segment where people are bullish on. So even he says this will play a huge role going ahead. So you have rural economic picking up, then you have media or entertainment segment which is also there, which can also do very good. So he's trying to bet more on these two and more focus towards rural India. And the third part basically comes apart from these two is the infra and the real estate. But these segments, what you're trying to look at, capital goods and real estate, these are all the old underperformed sectors. So this is fine. He's trying to merge with this guy, but these two, he's trying to look outwards what will happen in next 10 years or so. So that's very, very good. Poultry farming on the verge of increase. Yeah. So all these things are there, right? So that's what I'm saying. First, you should know where to focus at, right? Then you start looking into the sector. Then you start looking into stocks. So we cannot just start which stock is good. No. Okay. So the broader frame, I've got now two kind of people telling me two information. One guy is telling me underperformed sector. Right, so underperformed sector. The other guy is telling me about, right, so this is very, very important. So hence I try to say these two are the best guys to look into, and there are many more who are there, and we can also look into them. But I find these people, since they have more experience and they also know where the markets basically will turn for next 10 years or 15 years. So they do not say targets on the market. They very well know these things will happen or not. So new theme will kick in or not, or new sectors will happen or not. Now, after these, you have a guy called as Basant Maheshwari. Now this guy, try to understand, this guy only looks for growth stocks. So you'll understand what is growth stocks and what is value stocks. What these guys were looking into was called as value stock, and this guy is looking into is called as growth stock. And you also have one more guy which everybody knows, Ramdev Agarwal. He is also focusing on growth. So the point here to be understood is this guy, when he's trying to focus on growth, and same is with Ramdev Agarwal, why are they in a different camp and why are they in a different camp? They are called as value and they are called as growth. Now, to understand in simple way, these people focus on 52-week high companies. These people focus on 52-week low companies. If you do not understand value or you do not understand growth, the simple way to remember is these people will talk about sectors or companies making 52-week low or they are fairly corrected. These people will talk about stocks which have zoomed up, okay, and has huge potential of growth for next 3 years, 5 years, and so on. So these people are more towards growth and these people are more towards value, right? Now, apart from these, you have someone called as Prashant Jain, which is of HDFC, AMC. Right? I don't know how many people know him, but this guy is the best guy because this guy is very good in macros. Obviously, he's good in picking sectors also, but he will tell you when the economy is going to go up. So if economy goes up, GDP goes up, what will happen if earnings of entire country goes up, the index will also start going up. Right? So this guy is very, very well versed with macros. Now this guy normally does not come more than like once or twice in a year. That's it. Correct? So this guy is very clear about what things are happening at ground level, what things are happening in future level and those kind of stuff. So this can be heard or listened to for macros, where the economy is headed. Okay, so if you want to look or understand or where the economy is standing, Prashant Jain is very good. And there is one more guy called Nilesh Shah. But that guy is good to listen to, right? So he'll talk about everything. But he is very good guy in explaining stuff. If you listen to this guy, you will not even understand 10% of what he's saying. Correct? So he talks high language, he talks low language. But both talk same things. But try to understand, the moment you try to understand this guy, you will also lead to a higher language criteria. But that's what I'm trying to say. This guy tells you more about macros and these guys tell you more about sectors and themes. Okay, so one thing is now very clear. We have got few people, or we can all obviously go and read more magazines and stuff like that, where you can get sectors and themes. Right. So this is the core agenda. Sectors are very easy. Go back and see the history of sectors. Have they performed or have they not performed? So on our terminal, we have already placed the index analytics. I'll show you that. So this underperformance of sectors, you can straight away get. Don't worry on that. Then comes the new theme, which is challenging. Now, how do you find new themes? You keep reading to that question and answer of ET paper of every fund manager. Some or the other day, you will get a new theme that they are talking about. Some fund manager will talk about. So that's what is also very, very interesting. So now I'm very clear. My portfolio has, can I say, new theme, stocks coming from this, and stocks coming from sectors which have underperformed. Can I say these are value stocks? And now I can also say, I can also have some portion of my portfolio which are what? Growth stocks. Right? So you can have now three parts of your portfolio. One is your new themes, second is your value stocks, means underperformed sectors, and sectors which are performing can be a growth stock also. Right? So you have this. But majorly, where will you invest more? Should I invest more on growth stock or should I invest more on first and second? Right, so you can invest here, but allocation should be a little less and it should be more towards new theme and the value stocks which are there. Okay, so this is very, very important to understand when you're trying to put your portfolio together. So on the broader frame, we have yet understood that my portfolio will look like this. I will have few stocks from new themes, few stocks from underperformed sector, and maybe one or two from growth stocks. Correct? So where to look at, we have got some part of understanding. Obviously, we need to know from where to get sectors which have not performed, and you can also have new themes merging in your portfolio. So once you have this in your hand, now you need to start looking into stocks. Correct? So before we get into stocks, you need to understand market, you need to understand sectors, you need to understand new themes. Once you have understood this, when you have something to dig into, now you are trying to look into stocks. Clear? So I hope at least we know that first we need to understand where the market is. So we'll understand that. And then we need to find whether the sector is over performance side or underperformance side. And third, to find new themes. From where will you find new themes? Directly we'll find it from the Q&A from all the fund managers or listening to commentaries. You can understand the new themes. But underperformance sector can be looked into history and see which sectors have not performed. And also you can listen to DS Naren or Kenneth who are focusing on 52-week low kind of companies. So this is where the underperformance will kick in. And then after knowing how to visualize the market, right? So this is more or less what you need to understand. But in simple and plain, please understand one simple thing. You can do whatever you want, okay, of selecting these stocks and sector and everything is fine. But always try to understand, do not invest in exuberance level. So can I say, we will always invest when things are bad or things are good.
I have a question before that. Will the hold time differ for in the portfolio? We have different.
We have yet not come there. So we'll come to that point, how much time to hold those stocks, how to find the stocks, when to buy the stocks, those things are yet pending. So my first question is, if you're trying to invest, the scenario should be bad or scenario should be good? Let's say of market, let's say of that sector. It should be good or it should be bad? What do you think? It should be bad. We don't want good. Because try to understand, if scenario is good means everybody is talking good about that sector or that company. So if you want to invest, you always look for bad time for that sector or for that company. Now please understand, what do you mean by bad time? See, every company or every sector, let's first take sector, and obviously companies will come in that sector. Every sector, be it any sector or any business, it will have something called as cycles. Okay, so you have a good phase, you have a bad phase. You have a good phase, you have a bad phase. When the phase is good of that sector, everybody is talking good about it or no? Every management will also tell you or give you a rosy picture. You know what? I want to increase my sale 5 times, 10 times, 20 times. Very good. And you will also concur or agree with him because he has performed or not. He'll say, you know, just see 20% year on year we have growth on our sales number, and I think we will keep growing for next 5 years. And suddenly when he says for next 5 years, what happens? Bad time comes. The same management now says what is to be understood. So the best part of any stock that you want to invest in, okay, we need to see what they do in which phase. Bad phase. If there are lots of challenges, and in that bad phase also, if he is able to increase the sales and maintain the profits, good or bad, because the other smaller companies in the bad phase will go out of business or no. But what are we trying to look at? We are trying to look at these outliers. Who has performed in the bad phase, or what have they done in this bad phase? The down cycle will basically define a company. Please understand, right? Because in down cycle, only those companies will survive whose managements are the best or not, whose products are the best or not, whose capacity or whose operations are best or not. So all those things, whether that company is suitable to be in your portfolio or not, is not being understood at good phase, is always understood in the bad phase, right? So I'm not saying the company is going under a bad phase. I'm saying a sector is going under a bad phase. For example, this ILFS issue happened. Okay, so there was a huge credit crunch happening in the entire sector. Which companies or sectors went down? The financials or no? Correct. So after this phenomena, the point was all the financials went down. Okay. Before this, if you remember, there was something called as demonetization. Again, in demonetization, two went down. Financial, NBFCs, all these went down. So these were the bad time of that cycle or good time of the cycle? Bad time of the cycle. All I need to see, if I am selecting a company in financials, during these times, what they had done. If they have done good, means they were not getting hampered because of these phenomena, don't you think you're looking at a huge upside in those stocks? So the point what we need to understand is, when the environment is bad, the companies will correct in price, agreed. But after that, are they still holding on or not? If they are still holding on, that means there is something important about that company, or you can say something special about that company. So the point what we need to know, these bad circumstances will actually be a litmus test, right? Whether they are able to sustain or no. Okay, and this is what we are trying to look at. During the bad phase of time, we will find our outliers, right? And that's where someone has to understand, when you are looking at, don't look at only the good phase, go back in the history and see which were the bad patches, and in that bad patches, what they have done. Okay, and you will understand the way we will select our stocks, it automatically takes care of this bad patches. Plus, you can again be reassured during this bad phase how the stock has performed. If he has performed good, don't you think you will put more allocation to those stocks? Correct? So that's what we need to understand. So every sector, every company will go through two phases, and we want to invest in those stocks who have gone through bad times or no. Correct? So that's my point of understanding whether that stock will be good or not to keep holding for next 3 years or 5 years or 10 years. the first point to be understood is I want to invest in bad time. Okay. Now we were talking about bad time of that sector because of some you can say external factors. The entire sector went down. Tell me if there is a bad time for the market. Is there a bad time or no? Market also has a good time and a bad time, right? So like 2008, 6, 7 and 8 were good time or bad time? Till here it was good. After this what happened? It reached into bad time. So market also has good and bad time or no? Now please understand. When everything is going good, if market itself is in good phase, what will happen to the sectors? They will also be in good phase. And few sectors might be in the bad phase, right? But when it comes to the bad phase, if the entire market is in bad phase, okay, then if you look at those companies, if they are still performing, what will happen? Right? So what are we trying to look over here? We are trying to look to invest during what time? Bad time. Now this bad time can be two parts. It can be from sector. It can be from, but it's very clear we are interested in the bad time. Right? So if things go wrong, what has happened? You tell me. That's very, very important. Right? So the point what we are trying to look at, and this is what even Warren Buffett says. If you try to see, what he says is you should invest when others are fearful. Okay, fearful means what? Bad time or good time? Bad time. When markets are crashing, when that sector is crashing, when that company is crashing. He's saying go and look at those companies which can survive this downturn, and if it has survived, just go and invest and forget about it. Okay. The second point, what he said was invest when others are fearful or when it is a bad time. And try to be skeptic or on the alert side. Do not invest when others are greedy, or you can say when everything is good, market is good, sector is good. Don't you think you have entered which phase? So what should you do? Not invest more, but start removing your money or exiting some of your investments. So the same phenomena, what he's trying to say is exactly right. And try to understand, as per human psychology, we do not fit in. It's very difficult when markets crash to go and invest, and when markets go up to go and book your profits. Why? I'll tell you. Let's say market, if Modi ji does not come, goes down by 10%. It can go easily 10% because of demonetization, Brexit, it has gone in one day itself 10% now. So if Modi ji not coming, 10% and 10%, 2 times it can come. So if it goes down 10%, if you ask, will you invest now? No, I will wait, I will see what is happening, who is coming, the third front is coming or this is coming, and then I will invest. Okay, fine. Third front comes another 10% down. Okay, the same one is saying, see, good, I did not invest it over here. Now, will you invest here? No, I doubt now things will work or no. Because now third front has come. I don't think economy will revive or GDP will come. They will not do any reform. And by the time they are thinking for further downside, it makes lifetime money. So please understand. So what's happening over here? Can you catch the bottom? No. Right? And this is what human psychology is. And this is what I have seen the best which happens in gold. Okay, everybody wants to buy gold and just see what will happen. And I interact with so many people as the retail participation. Just see, if the gold goes from 28,000 to 30,000 and 33,000, they will keep asking, when will it correct? When will it correct? I want to buy. Okay, fine. So now, when it comes to 30,000, good, it has corrected or no? Now you should invest or you should buy. They say, no, now it will go further down. Okay, and they are right, it does go to 28,000. Now it has come back to 28,000. Now you should invest. No, now it will go to 25 or 22. All the newspapers and all the news are telling me that. Fine. And he keeps waiting for what? And this guy never comes and it reaches again back and forth. So what do you see from this example? The problem here is we keep waiting and that time never comes, right? So the point is to be understood first is, are we having correction or are we having crash. And this is what people do not know. Okay, crash will happen. Market goes down how much? 50%. Correction means what? Market can go down 10, 20, 30%. This is not crash. This is what? Correction. So first phenomena is to be understood that will it be correction or will it be crash? When something starts like correction, what we feel it will become crash. It never becomes, and then market zooms up. Okay. So the point here is first to understand that are we looking for a correction or are we looking into a crash? Now how do you know or how will you know whether correction will come or crash will come? So if you go back and see 2000, if you go back and see 2008, during both the time what has come? Now if you go back and see 2016, after Modi ji came and it went sideways and the market did go down, but it go down how much? So was it a crash or was it a correction? It was correction. So the point is, how do I know this will happen or this will happen? Correct? So the point is now to understand if Modi ji is not coming, it's a big event, agreed. Now can you tell me correction will happen or crash will happen? Are you getting me? So if I tell you a way where you can now find that correction will happen or crash will happen. So let's say, if I say correction will happen, Modi ji not coming, correction will happen. So don't you think you should wait for 30% downside? Or should you wait for 50% downside? If I say Modi ji is not coming and crash will happen, that means potential downside will be how much? 50%. And if it is 50%, then you can wait for 30% or no and start investing. Second, if I say Modi ji will not come, correction will happen. If I'm using the word correction, how much point down and I'll start investing? 10 to 15% and I'll start putting my money because max it can go where? Is 30%. So the point what one has to understand, how much deep the hole can be, please understand. Okay, we understood whether this will happen or this will happen. Now the question is, how do you know this will happen or this will happen? Okay, and I'll give you a way where you can now find whether A will happen or B will happen. So if I give a way to find this will happen or this will happen, now you are very clear or no of downside. Right? So you do not keep looking at, no, I will still wait because I think another 10%, 20% is left on downside and I'll try to catch the bottom. No. Correct? So if I tell you correction will happen, start from 15% your investment. Do not try to get more down and invest. If you are looking at a crash phenomena, then yes, you keep waiting, not just for 20%, even for 30% and then start. So don't you think now you've got a trigger to start, right? How much downside is there and now I can start. Now the question is how to know this is there or this is there. But first you need to understand that crash doesn't come more often. 50% downside, if you go and see when it has happened, and before this it has happened in 1992. So if you see over here, don't you think more or less 10 years gap is there? So crash happens once in a while or every 2 year crash happens? Once in a while, correct? But this can happen more often. 10% is normal cakewalk, anytime 10% down. If you see ILFS phenomena, which was at 11,700 last time, it came down to 10,000. Now there was no election, nothing, there was just an event, and once one event can bring him down how much? 10-15%. So 10-15% is normal phenomena or no? Okay, so this is what the correction on the downside will always tell you how much deep things can go. Okay, and now you tell me, if you see the mid cap and the small cap and everybody is crying, all the mid cap and the small cap had corrected very, very fast in last 1 year or so. So if you see the top from the mid cap and the top from where the small cap has gone down by 50%. This guy has gone down 20 to 30%. So if I have invested in mid cap index, it has gone down by 20% or 30%. If I have invested in small cap, it has gone down by 50%. Now please understand. The first thing is to understand, is this a correction or is this a crash? This we are talking about what? 50% downside is a crash, but for whom? Nifty or large cap, please understand. If large cap goes down 10-20%, mid cap will go more or no? Small cap will go more or no? So the point is very clear. Who is more aggressive on downside? Small cap, then mid cap, and then large cap. Even on the upside, who will give you more returns? Small cap, then mid cap, and then large cap. So returns wise also he does not give you much. So risk is also less. These guys can give you more on return. So risk is also more. Now let's see. When you go back and see this big crashes which happened in large cap 50% down, that time the small cap went 80% down and this guy went almost 60% down. So the extreme scenario I'm saying, large cap goes down by how much? 50%. These guys go down how much? 60%, and this guy goes down how much? 80%. Now, when this has happened, can I say there was a crash in small cap and mid cap? No. I should say what? There was a correction. Is it clear or not? So the first thing we need to understand whether correction is there or crash is there. Right? And it's very, very clear that crash is 50, 60 and 80. Okay, so if you go back and see 2008, this is what, or in 2000 also, this is what you can see. So crash, whenever this Nifty will crash, these segments will go down this much. And if the correction happens, 10 to 15% is normal in large cap, then normal is 20 to 30%, normal is 50%. So now when small cap went down 50%, was it normal or abnormal? It was normal. Now why it was abnormal for people? Because they invested where? That is why they are saying, you know what, my portfolio is down 70%, 50% because your entry was wrong. Correct? So the point is very clear. Now if you ask me, should I invest in small cap and mid cap or no? Correct. So it has undergone a good correction and now I can invest. Right. So this is what one has to understand. Rather than entering at the top phases, we should enter in the corrected phases. And again, the question is it bad time for the market of mid cap and small cap or no? Because it has corrected. Now if you ask people to put money in mid cap and small cap, they'll say, no, I'll never put now in small cap. I'll only buy large cap. Correct. Why they'll buy large cap now? Because the markets are down. Their portfolios are down by 50%. When they say that, it is bad time for them, but good time for us. Correct? So all I'm trying to say, whenever a correction comes, it's an opportunity to enter. Whenever a crash comes, it is once in a lifetime opportunity. Because crash normally takes how much time to happen? 10 years. So please understand, if you are 25 years of age, how many crash will you see? 25 years of age till 35 you will have one crash, then 45 years you will have one more crash, and 55 years you will have one more crash. Okay, and means you have one time to become millionaire, then second time and third time will not apply because you will try to now be a little safe because you cannot play risky. Now let's talk about the guy who is over here. How many chances he has? He only has one chance. And the guy is already 45, 55, forget about it. You will not take risk. So the point is, please understand, you do not get more opportunities, right? So the opportunities are very rare. That 30% downside also if you are getting in correction mode or 20%, it's a good buying opportunity, right? Now we need to only see if the crash phenomena can come or not, but otherwise this is a very good entry point or not. So it's very clear now that if you want to eye or trying to put or allocate more money, we are looking at corrected phase of 20 to 30%. In what? Large cap, mid cap, almost 30%, and small cap, 50%. Right? So it's very, very clear when we are looking to invest in. When the corrections happen, we are looking to invest in. And we also know if it is a correction time or it is a crash time. Correct? So it's very clear how to know, I'll tell you, but the agenda is very clear. If you get this opportunity, we should keep waiting, no problem. If you are having this opportunity, still you should invest. Correct? Now many people say, you are saying correction 20% and then the sudden crash comes and it goes down to 50%. Correct? It can happen. But you need to understand, if you have invested here, don't you think you should invest more here? Don't you think you should invest more here? Correct? So every point in time, you should invest. So if you want to make good money, please understand, you have to invest in what? Bad time. And now I will say, you have to invest more in the downside. So if your portfolio is not giving you return, be happy, don't be sad. Right? All you need to do is correct stock needs to be bought. And then let's say portfolio is not giving me return for 1 year, very good. 2 year, very good. 3 year, very, very good. Because what will happen? One big fall will come your way. And then what you need to do? Add more to your portfolio. So the point what we are trying to see is add more. And when will you get chance to add more? In the downside, not in the upside. So don't try to cry that I have not got return in 1 year, 2 year or 3 year. Right? Agenda is if you have not got return in 10 years, then you have done royally wrong. Something has gone wrong. Right? So in 10 years, my agenda is to make money. And every downside should be celebrated. More the downside, you are getting more time to put money before a huge upside starts coming in. Right? So please understand, when you're trying to place your bets or trying to make a portfolio, the timing is what everybody cares about. It's not about which stock or which sector you are looking at. Right? So timing is very, very important. And it's very difficult for human nature to buy when the market corrects. Everybody can buy when markets go up, but it's very difficult when market go down. Now let's talk about everybody can buy when market goes up. Okay, so market goes up, then up, then up. People who were seeing this and were left, it's very difficult for them to buy here. They keep seeing and then market comes here and then finally they pull the button. So they get very late or no. Second, if someone who is bought over here, what will you do? If it has not performed for last 3 years, he will sell or no? If you buy something and sell, so let's say you bought something at 1,000 rupees and you sold it at 1,500 rupees. When will you re-enter again? You bought at 1,000, you made money, you sold it at 1,500. Now when will you try to buy it again? Will you buy at 1,700 or 2,100? No. So you will always say, I will now buy when it comes to 1,000 again. So please understand what is happening now. He never comes to 1,000. So if people who buy in the up market also face a loss, and this is how the nature is. Right? What they are trying to see over here is fixated with what? First, you never understood why this 1,000 became 1,500 in the first place. Why? Because the earnings went up. And if the second quarter earnings have also gone up, do you think this guy will come to 1,000 now? No. Correct? It can go to 1,200, it can come to 1,300, but it will again go back to 1,700 or so. So it cannot come to 1,000, it can come halfway and go up, and sometimes not even halfway, can keep zooming back. Correct? And this is what people do not understand. Let's say some people got IPO, DMart at what rate? 300. It got listed at 600. So people who got, they were very lucky. They said, okay, fine, I should now book my profit. So they sold it at 600. Okay. Those who did not get, they can buy at 600 or no? Now they are also not buying because 600 is too much up to buy because he has given at 300. So I'll wait for it to come down to 500 or 400 and then I will buy. 600 becomes 800. Now this guy who sold, he is also crying. The guy did not buy, he is also crying. Please understand. But both the guys, the guy who sold and the guy who did not buy, never understood why the price went to 300 to 600 to 800. Because he continuously went to 800, forget 800, it went to 1200 because all the way Earnings went up. Clear or no? Right? So just a minute. They do not see why the price is going up. Okay, they do not see because of earnings. The same DMart would have come down if earnings wouldn't have gone up. Correct? So this is what one has to understand when you're trying to get into. So we'll take all these things. Right now I'm just trying to pitch you the structure, how you need to think. That is more important rather than knowing how to get the stock. Right? So knowing or getting the stocks are very simple. Again, I'm trying to say the agenda is to hold the story from 300 to 600 to 800 to 1200, maybe even to 3000. To hold or to fold is more important in investing. How will you decide to fold? What do you think? Which is a good price point on DMart when I should sell my shares? What do you think? Will it be 1800? Will it be 3000? Will it be 5000?
Price is going up and up.
Absolutely. So don't get fixated with this number. You have to get fixated with whom? Is growing right now at 40% or 35%. If it comes to 20%, what should you do? Then you exit. Is it clear or no? So the point what I'm trying to make is two important pointers. One is we invest in bad time and we are investing more, that is called scaling, in downside of the market. Just keep putting money, do not worry. The second point which we have learned now is the focus has to be on what? Earnings. Right? So the entire focus should not be price, it should be earnings. Right? So the structure is now very, very clear. Please understand. If a sector is going through a bad time, market is going through a bad time. If I tell you market and sector both are going through a bad time, good or not? Let's say large cap is corrected by 50%, crash has happened. Okay, fine. So if entire market has corrected, Mr. M has corrected, everything will go down. Now apart from that, if I tell you the crude oil has gone from 60 barrels to 100 barrels or 130 barrels, who will suffer a lot? Paint companies. Correct? Or tire companies who will make, or rubber, or these companies who are basically using this as a raw material. So if I say the petrol prices or this oil has gone up, okay, market has corrected, what will happen to Asian Paint? It will also go down or no? Now please understand, there are two things which have happened. Market has gone down, because of that also Asian Paint has gone down. Plus what has happened? Oil has gone up and the Asian Paint has gone down. So don't you think double whammy downside has happened on Asian Paint? Okay, the market went down, all the stocks went down, it was normal. But apart from that, if the price went up of the raw material, he is suffering more. So if I now buy Asian Paint, is it a good time for that industry or sector, or it is a bad time? Bad time. Plus the market is also in good time or in bad time. So if you have bad time of market, bad time of sector, very good or no? That's the lowest price you can get for that stocks, right? So when can we get the best stock at the lowest price? When you have A and B happening together. Now recently what happened, I'll tell you. The same crude oil was somewhere around $30 or no? Then it went to 60, then it went to 70 and 80. And there is a stock called as Interglobe Aviation, which is nothing but Indigo. So it was trading at 1300 rupees or 1400 rupees. It came down one way to 700 rupees. So how much percent downside? And markets also corrected because of that ILFS issue and stuff. So market was correcting and the stock was also correcting. Now this stock has to correct because market was correcting, fine. But apart from that, what happened? Double downside or no? Correct. And when you would say that below 1000 rupees it is a huge buy. Now people saw 800, then people saw 700. Will they buy? No. They are waiting. And still now they are waiting. right? Because now the oil has become stable around $60 to $70 and market is back all-time high. More than that, jet is going out. Correct? So number of flights which 5 people used to fly, now only 4 people are there. So who will fly the extra flights? Indigo. So the same price now goes to 1400. Now everybody wants to buy Indigo. You understand? So this is what the difference of investor comes into mind. If you were Warren Buffett, what will you do? Buy during bad times or good times? Correct? So if you buy it during the downside mode, okay, then you can expect a huge upside mode. And please understand, it has been like 6 months and the price has been doubled. Correct? So what we need to understand is how to select a stock. But before you go to a stock, please understand, we are looking for bad time of market and bad time of sector. If both the things happen at the same time, you get stocks at the cheapest valuation. Okay. Now if you see, the markets are back all-time high, but auto sector is performing? No. Correct? So first thing, if you see auto sector is not performing, but market is up. Can I say both are down? No. Okay. So both are not down. So tell me one thing, if Maruti is a stock which was at this time when market was also good and auto sector was also good, the sales were also happening, both were very good. Maruti price reached where? 10,000. Now suddenly market is still at all-time high, but auto numbers or sectors are not performing. Maruti has corrected by how much? 30 to 35%. Now why has he corrected? Because the auto sector is not performing good. So good time for Maruti or bad time? Bad time. Second, if market now undergoes a fall, so Modi ji does not come, market will also undergo 10-20% fall or no? What will happen to Maruti? It can go to 5,000 or 5,500 kind of more. Don't you think the same 10,000 rupees stock has gone down at 5,000 rupees? Okay, 50% downside or no? Like Indigo. This is what one has to merge. A sector going down is fine. Club it with market going down, you get the same stock at the lowest valuation to buy. Right? So that's very, very important to understand. So with this logic, we should look at Jet Airways. Yeah, we'll come to that stock. So please do not get into stocks right now. And I'll also tell you which stocks to talk about. Why am I talking about only Asian Paint? Why not Shalimar Paint? Why not Narrowlag? Why not other guys? Why am I only talking about Indigo? Why not SpiceJet? Why not other guys? Right? Why am I only talking about Maruti? Why not Tata Motor? Or why not other guys? So please understand. So examples are not randomly taken. Okay. So there are some features about these guys. Why I only talk about them and not about others. So we'll come to those pointers. Do not worry. But first thing that you need to understand, when you're looking to invest, the time should be good or bad. It should be bad. Bad for the sector and bad for the market, right? So that's very, very important. And second, you can invest more if what happens? More is the downside. Okay. And the second point which one has to understand, if you have invested and if the earnings starts improving, what will happen to the price? It will start going. Right. So that is also again known that price will follow earnings. So you should follow earnings and then automatically you will know price is going to go up or not. Right. So that's very, very important. The price earning phenomena and when to invest. So we have addressed now when to invest. Okay. Now after understanding that bad time is good to invest, okay, for sector and market, and we try to focus more on earnings rather than price. This is all about the outer structure which we were trying to focus on. And we also now know that this market has 3 phases and then sector also has 3 phases. But we look at what kind of sector and apart from sector, we also look for, so we focus on new themes, we look at underperformance of the sector and market has 3 phases. So if it is in phase 1 and phase 3, very, very important. If it is in 1 and we look at underperformed sector, Don't you think this will be a best combination? Both are down. Sector is already down and the market has also gone down. So we get something at the lowest valuation. This is what we are trying to merge for downside and bad time, right? That's very, very important to understand. So this more or less the phase phenomena, the sector investment of underperformance and new theme. And after doing this you do the analysis. Then obviously you select stocks and you will invest and then you will start tracking. Now what do you track? If you invest in these stocks, you will invest in good time or bad time? In bad time, and you will start focusing on their earnings. Correct? So this is what we have learned till now. Market has three phases: sector which have not performed, new themes that you should look into, and now you should have stocks. After doing all of this, if I figure out which stocks to invest in, I should know when to invest in during the bad times, and then you should also know the earnings. So once you invest, start focusing not on the price. It's not moving, forget about that. Start focusing on what? The earnings, right? So now there were two main questions. First question from this entire flow was, how will I know market is in which phase? Correct? So first question was, how will I know the phase of the market? Okay, and the second one, how will I know which sectors have not performed? Obviously, you can listen to SNRN and those, but we need to find which sectors have not performed, underperformed. Right, so let's answer these two. And then once you know this and this, you can now know themes by reading more. And then we start our second part, which is what? How to select stocks in these sectors or themes. To know about market phase, you need to look at 3 pointers. What are they? The first point is returns. Past returns of the market. Okay. So returns, let's say even if we see 1 year return. So if you want to see now 2019 where the market is standing, I need to go and see last 10 years, 1 year return. Okay. So return is very, very important. Past return is there. Second is something called as price to earning ratio. Okay, so this is also very, very important because this will help us to know the valuation, whether the market is highly valued or lowly valued. So price to earning ratio is very, very important. Returns 1 year till last 10 years. Yearly returns till 10 years, very, very important. After the P ratio thing, you can also look at price to book value. Okay, so price to book value basically understands leverage. So whether the company or whether the industry or whether the India or the large cap companies which are there, are they highly leveraged or they are lowly leveraged? So when I'm trying to look at market phase, I'm looking at 1, 2 and 3. Correct? So in this case, we'll try to see what to look at. Price to earning ratio will give us valuation and price to book value will give us leverage. Right, so we'll go into each of them. We'll take a break, and once we come back, we start with analyzing the market phase through 3 factors, and then we look into the sectors.